evening, everybody. Nice summer evening. Hope everybody's enjoying the summer weather. Today we've got Dean Jekins back with us. He's always got very good training information. He's the founder of Follow Me Trades. He's got well over 20 years of investment and trading experience, and he makes his living trading equities and options. He's also coached quite a few people all around the globe, helping them reach their financial goals. So he's an expert in technical analysis, money management, Elliott Wave, and I can never say this right, the Ichimoku Cloud. So with that, Dean, welcome back. We're anxious to see your information tonight.
All right. Hey, thanks, Stephen. Thank you for inviting me back. Thank you, traders, for being here tonight. You know, I come to this forum about once a year. I've been doing this. I've been coming here 4 or 5 years, and I always enjoy it. It seems like a really engaged, active crowd and some serious traders. So I'm really glad to be here. I'm looking forward to presenting this topic. And by all means, please type in your questions. Make it interactive. You know, get the most out of it that you can. So as Stephen said, I'm Dean Jekins, founder of FollowMeTrades.com, and yeah, I love trading. I love technical analysis. I love talking to traders, talking about trading, teaching. And tonight I'm going to talk to you about Ichimoku Cloud and Elliott Wave. I call that East meets West. And you know, on their own, they're both pretty good trading systems. But when you combine them, some really cool stuff happens. So I look forward to sharing that with you tonight. So, quick disclaimer: I'm going to show you some of my favorite trades right now, trades I'm in, and then trades I'm getting ready to take. And I'll be happy to analyze any trades that you're interested in as well. But you know, I'm a trader. I'm not a financial advisor. I'm not giving financial advice. So, you know, it's my opinion. Whatever you do is your decision. Everybody makes their own decisions. But you know, again, I'm not giving financial advice. So here's what I plan to cover tonight. I'm going to talk about the tools that I use in my trading. Just a little bit about Dow theory, a portion of Dow theory. It's an important component of my trading and analysis. I'm going to give a brief overview of Ichimoku Cloud, brief review of Elliott Wave theory, then I'm going to talk about how I use them together, and they come together in a pretty powerful way. I'll share some of my favorite trades, current trades, both ones that I'm in and ones that I'm getting ready to take, and I'd be happy to analyze any charts, any stock charts that you are interested in. And Robert's asking, is Ichimoku related to candles? It's not, and I'll explain what it is. But it can be combined. So I combine it with Elliott Wave, but you can combine it with any other complementary analysis technique. So, you know, you could combine Ichimoku Cloud with candlesticks and, you know, kind of double the confirmation and confidence of a particular trade setup. All right. So here's the 3 key tools I use in my analysis and trading: Dow theory, Ichimoku Cloud, Elliott Wave theory. Let's talk about Dow theory for just a moment. So Charles Dow, super interesting guy. He's the founder of the Wall Street Journal, and he'd done quite a bit of research and thinking, and he published a series of editorial articles at the beginning of the Wall Street Journal back in the late 1890s, and those editorial articles on market theory have been compiled into what's known now as Dow theory. And one of the things he pointed out was trend analysis. And he said something really important. And then when you see this, it's like, well, that's incredibly simple and obvious. But if it's not pointed out, maybe you miss it. Right? He goes, hey, an uptrend is defined by a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. As long as that pattern continues, you're still in an uptrend. Well, that's really important because price does not move in a straight line. It goes up and pulls back, goes up and pulls back in an uptrend. And a downtrend is just the opposite. It's a series of lower lows, lower highs, lower lows, lower highs. And as long as that pattern continues, you're in a bearish trend. You're going down. And that can add tremendous confidence and tools to your trading because, you know, we all love to get into, you know, say a long trade and have it go up. But then when it pulls back, you know, you get a little sweaty palms. You go, oh, should I get out? And it's nice to have a rule and a theory that says, well, no, really, you should have set your stop here at this low, and this we expect it to pull back. That's a very normal thing in an uptrend, move and then pull back and move and then pull back, and we can set our stops at these reversal support levels, right? And we have reasonable confidence that the trend is going to continue. How do we know when the trend is over? Well, first thing, how do we know when the trend started? It takes 3 data points. It takes a high, a higher low where price does not go below here, and then a new high. At this point, Charles Dow says the trend has begun, and then it continues, right? And then when did it end? Well, when it pulls back and it doesn't make a new high, and then it takes out that previous low. And that's where the bullish trend ends. And if you look, that's exactly where the bearish trend begins, with a low, lower high, new low. And when does it end? With a higher low, doesn't put in a new low, and it goes and takes out that high. So these are, and you can just see this on a chart. And, this is a powerful analysis technique all on its own. So I use this as I look for trend changes, and then I compare it with some other tools. And if this analysis technique, Dow theory, aligns with what Ichimoku Cloud is saying, and if it aligns with Elliott Wave, I've got 3 completely separate analysis techniques that are all screaming the same thing, and that becomes very powerful, right? So the more things that say the same thing, the more powerful the case for a trade becomes. You want to be careful not to stack too many techniques, too many indicators onto your chart, and particularly ones that would be conflicting. Indicators that indicate oversold, overbought conditions are sometimes going to conflict with a momentum system, right? They're going to say, just as we think the trend's getting going, that it's maybe overbought or oversold. So Ichimoku Cloud, this is a cool deal. This handsome gentleman on the right is Goichi Hisada. He developed the Ichimoku Cloud. It's known as the Ichimoku Kinko Hyo, which means one look equilibrium chart. And Goichi Hisada was a Japanese journalist. Most indicators and trading systems are developed by mathematicians, economists, that kind of stuff. But he was a Japanese journalist, and he was working on this in the 30s. And he spent a lot of time developing it, back testing it. He published his book in 1969 that described his theory and how to use it. So, what is it? So let's start with a question. How many of you attending tonight think that moving averages matter? How many people use moving averages, whether it's just an SMA or exponential or something like that? How many of you think moving averages matter in your trading? I got people typing in yes. Yes, sure, yes. Okay. Yeah, I think a lot of people use moving averages to some degree in their trading, right? Absolutely. And they do matter. Right? They're historical, they're lagging, but they have some meaning. And, just the fact that, and I like Roberto's comment, only the big players watch them. And it's kind of like, I have the 200-day simple moving average on my chart. Why? Because it's the most popular indicator on the planet, and everybody else is watching it. So I want to see what everybody else is seeing. And, is the 200-day moving average predictive on its own, or does it matter because everybody else is looking at it and responding to it? Well, ultimately, I don't care. I just know that quite often the 200-day simple moving average on a daily chart for equities provides support and resistance, and crossing that line matters, right? So everybody else watching it, I want to know what they're seeing, and I want to know too. All right. Ichimoku Cloud, at its core, if you just boil it all down, it's a different look, and it's a different bit of a formula at moving averages. That's essentially all it is. But it's an important distinction and difference how they do it, right? So a simple moving average, just for review, it's the average closing price over X number, some variable number of previous bars. Most people use 2 or 3 simple moving averages and look for crossovers and direction. And then there's, of course, exponential moving averages and some other derivatives of that. But it's looking back at the average closing price over some variable number of previous bars in history. Ichimoku Cloud looks, rather than at the closing price, they look at the highest high and the highest low over some number of previous bars. We got 3 look-back periods and some derivatives from that. So let's dig a little deeper into Ichimoku Cloud here. Right? So here's a screenshot of what it looks like on a chart. And the first line of note here is what's called the Tenkan line, the conversion line, or the fast moving average. This would be the fast moving average. I've bolded it in yellow on this chart. And the formula is that you look back some number of periods, X periods, right? And the default factory setting in your trading platform for TenCon is 9 bars. That's pretty fast. And so it takes the highest high and the lowest low, divides it by 2, gets the average of the highest high, highest low for the last, in the factory setting, 9 periods. Right? So it's very similar to a fast moving average line, fast simple moving average line. Shows the short-term trend. And then crossovers, you can guess this purple line is going to be a longer or slower moving average. And crossovers can indicate trend change, but they can also have some false calls. So you don't want to act just based on these TenCon and then the Kaijun line crossovers. Kaijun is the basis line. It's looking back a longer period. The factory setting, I believe, is 22 periods, 22 bars. So same formula, highest high, lowest low, divided by 2, the average for a longer period. And again, I believe that's 22 is the factory setting. I changed the settings. I got unique proprietary settings on that, and I'll talk to you about those. All right. So you got the yellow line, you got the purple line, you got crossovers. Crossover going up, crossover going down. Okay. Crossovers can indicate trend change, but these are pretty short on a daily chart. 9 periods, 22 periods, pretty short for trend calls, right? So we also have this saying, this cloud. Now we're introducing the cloud. The cloud has 2 lines. It's got this green line, and it's got this red line and a shaded area between it. So the green line, the fast portion, is called Senku Span A. Senku means going first or preceding. Okay? That's the faster part of the cloud boundary. It predicts future support in an uptrend, right? And it's highly accurate until the trend changes, when price goes crashing through the cloud, and that's important as well. So the formula to calculate this span A, the green line, is the fast line and the slow line, right? TenCon Kaijun, divided by 2, plotted X periods ahead. Okay, that's the, you can plot it into the future, and you'll see in my charts, I've actually pulled this back to current price bar, and I'll talk about why. Span B is slower. Okay, it's slower, and it's this red line, right? So it's kind of the lagging portion of it, and it's the highest high, lowest low, calculated back over some longer period of time, and the default factory setting on that is 50 something. Okay, 50 something, and so what you end up with is this cloud, right? And the classic approach to Ichimoku Cloud says, if you want to look for a crossover of Kaijun over TenCon, TenCon over Kaijun, fast over slow, right? It's easier in English. Fast over slow as the trend breaks the cloud. Well, what I've found from observation is, if you're going to break the cloud up, fast is always, it's axiomatic, it is always over. You can never find a case as price breaks the cloud that fast line is not over the low line. So I just took them off. Right? I'll just show you my chart. Now, what it looks like with my current settings is the S&P 500. All I'm really concerned with is this shaded region of the cloud. Right? I got the Ichimoku Cloud. I've got the TenCon Kaijun turned off. I just set them to 100% 100% invisible. They're gone. And then I've got the 50-day moving average, the 200-day moving average. I've got price oscillator momentum. That's really what I use here to analyze this chart. So it's a pretty clean, I think, chart setup, but this cloud is really, really important, and I use it. So Kumo is the cloud. It's the shaded region between the span A, span B, and the width of the cloud matters. With the cloud, just like any other moving average, is predicting support and resistance areas, but the width of the cloud is giving you the strength of the resistance. So, and it gives you a resistance or support region rather than an absolute line. And so you say, hey, support in this uptrend is in this region, and the thicker this cloud is, the stronger the support is, right? And you can see price breaks happen when the cloud is thinner, generally, right? As the cloud gets thin, and then the trend changes and price breaks through it. So it's remarkably accurate. We go back to the S&P 500 chart. Looks like there's a little bit of latency, so I'll let that build out for you there, and we can see it. You see Bill's gotten a little question about audio. Audio good for everybody? Give me a quick yes, thumbs up. If your audio is good. All right, this chart's caught up. You can see when the S&P 500 broke, the cloud was really, really thin. And look how accurate and predictive that was. At the times when the S&P 500 broke through the Ichimoku Cloud, there were some pretty decent short opportunities, right? And then when it, who wanted to go short in mid-October on the S&P 500 last year? Well, I didn't only want to, I did. I went short and we made some stunning profit, right? And then as it crossed the cloud again, right? Well, we had this uptrend, and then when the spring we had a little pullback here, and then guess where we are right now, right? We are down below the Ichimoku Cloud on the S&P 500. That might have some meaning to it, right? All right. This is what it looks like for me on TradeStation. I've cleaned it up. I got the Tenkan Kaijun lines turned to 100% transparency, and I just look at it here, and I'm really just looking for breaks through the cloud and then a prediction of support and resistance as where I'm in the trade. Robert says short all the way. Yeah, I think that's the bias I have right now to the downside. All right, so I use Elliott Wave as well, and I use a very simple, repeatable version. So if any of you are hearing me say Elliott Wave and you're rolling your eyes, type that in. I roll. ER. Right? Because I get it, man. I hear you. I feel you. A lot of the approaches to Elliott Wave are overly complex. They're subjective. They're not repeatable. The practitioners can't find, can't agree on the same setups. And I agree with all of that. All right, we got some eye rolls coming in. Thanks, Bernie. Thanks, Jay, Bill, CE. All right. Yeah. So I feel you. But there's a simple approach to Elliott Wave that actually has meaning. So the original theory developed by Ralph Nelson Elliott, interestingly enough, in the 1930s, the same time Goichi Hisada was working on Ichimoku Cloud, right? Ralph Nelson Elliott's going, wow, it really seems like there's this collective investor psychology or crowd psychology that moves between optimism and pessimism in natural sequences or waves. And it seems that these waves move according to Fibonacci ratios. At the core, that's what it is. After a big, long uptrend, it's inevitable that a stock is going to pull back. Right? Optimism, pessimism, investor psychology, crowd psychology shifts. So after a big move up, even for the best company, there's going to be a period of profit taking and correction. And lo and behold, that correction, even if the company's still great and everything's still cool, right, it's going to correct into a Fibonacci retracement zone range, and then after it retraces, it will continue on up to new highs. This pattern is shown here. This is the idealized pattern. You have an initial move up, a little pullback, and then you have this big, what's called an impulsive move. This is wave 3. Then you have a pullback. And then you have another impulsive move that really completes it, and then there's a complex correction afterwards. So one of the things that goes wrong with people trying to use Elliott Wave is they try to apply it to every chart, and the truth is it's not there. You can look at a chart, a terrible chart. Let me think of an example I've seen later. There are charts that maybe other techniques work on, or maybe no techniques work on, right? What is I saw one the other day that was like, it's chaos. Well, here's GM, right? Now, if you look at what GM is doing, right, you got a big down move, you got a big up move, you got a big down move to a new low, and then now we're just swinging around without any kind of pattern or order or clarity, right? And if you try to superimpose this price action onto, it doesn't fit at all. It does not fit at all, right? So trying to apply Elliott Wave to every chart, and particularly the chaotic charts, is a mistake. I look through on a daily basis in my trading room. I must look at 30 to 50 charts. I find 3 or 4 that are good, that actually conform to a pattern and have sufficient reward left in fulfilling that pattern. So it's not for every chart, and that's, I think, is one of the big mistakes and what makes people frustrated, and then some of the practitioners getting all geeky. Right? Here's the classic approach to the Elliott Wave. You got the grand super cycle and the super cycle and the primary, and then wave degrees and millennium and blah, blah, blah. There's 144 permutations possible. All you got to do is memorize those, right? Now that wave's easy. Yeah, I'm already feeling weary looking at this slide. So Elliott Wave really is easy because there's really only 3 setups, right? And they're either there or they're not. And you can, once you're trained and your eyes are trained and you have a little practice, you can spot them in about 1.5 seconds. You can pull the chart and see whether there's a tradable pattern there or not. Very similar to candlesticks, right? There's a handful of patterns. You see it, and it's either there or it's not. And it's black and white. And if you don't see it, you move on and go find a good chart. And so here's the book on Elliott Wave techniques. And I can't say that I wrote the book on Elliott Wave techniques simplified. The simplified is the operative word here. It's written by Bennett McDowell, who's the founder of TradersCoach.com. He's a good friend of mine. He's my mentor. And I can't say I wrote the book, but I can say I helped, because I did. I wrote a chapter in this book. So Elliott Wave Techniques Simplified. It's on Amazon. Belongs on every trader's bookshelf. And it's really, really good. And I don't get a commission on the book, but again, I think it belongs on everybody's bookshelf. Okay? Well, how does this work, and how do we use it? So, here's a real chart. It's easy to draw lines, but this is what Elliott Wave in action looks like, right? So we got a chart, right? We got wave 1, we got wave 2, and we like to check our entries for the impulsive move right here, right? So we got, and then we combine Dow theory: high, higher low, new high, and oh my goodness, it's breaking through the Ichimoku Cloud. There is a super good long entry: high, higher low, new high, breaking through the cloud. Looks like an impulsive move getting ready to start, right? And there it goes, up into, there it is. Oh, I love it. That will go 1, 2, 3, right? And then we ride this thing up, and we manage this trade, and we move our stop to new support areas. We take some profit along the way, and we ultimately close it when it low, lower high, new low. We close it here. And then wave 4 corrects. These blue lines, or these kind of cyan, light blue, right? Fibonacci retracement level. 38.2 to 61.8 is the expected retracement after an impulsive move. It did. It retraced, and then it did a little complex correction, and then guess what happens? We had a high here and a low, but then it didn't go to a new high. So we counted again, right? High, higher low, bam, new high as it breaks the Ichimoku Cloud, wave 5, right? Breaking above the cloud. We got the 3, 4, 5, and we can ride this thing up into this target zone for Elliott Wave, which is Fibonacci extension. So this is a Fibonacci retracement zone for a retracement, for a correction, and then a Fibonacci extension zone for the final impulsive wave, and that's 61.8 to 100% Fibonacci extension level. That's what we're looking for. So that's the, that's how we combine them. We confirm our entry using Dow theory, using a wave count, using the Ichimoku Cloud, and when it looks good, bam, we take the trade, and we win them quite a bit. And then we manage the trade by trailing our stop up to these support levels, and then ultimately get stopped out. Stay with the trade and the trend as long as it's going to go. Trail it up, take profit. I take it in thirds. Take a third. Let the final third stop on the final break through the support level when the trend looks like it's going to end. Let me show you before I take your symbols. And Bill says Bennett triangles. Yeah, these triangles are the art system from Bennett McDowell, TradersCoach.com. They're very cool. And if you notice where these pyramids are getting painted, doesn't that look like a high, higher, low, new high? There's a clue there, right? Pretty cool. All right, let me give you a few of the trades right now. I'll give you two that I'm in and two that I'm getting ready to get in. And then I'd be happy to analyze any symbols that you are interested in. So let's go live chart. I use TradeStation. Love TradeStation. It is awesome. So this took today. And guess what? I'm short. Ingersoll Rand, symbol IR. I always annotate my charts when I'm in a trade. So this blue cyan line is the price I got in. This red line is my stop. And that's where I will exit the trade. That's where my thesis, my theory about what's happening will have been invalidated. So that's the point I want to get out of the trade. And, you know, some people like to debate, should you have a live stop market order? I don't. I have an alert, and then I go close the trade, but I close it without fail, right? But this stop level, my definition of a stop level is a price point on the chart where I will absolutely exit the trade without blinking, without thinking, just do it because it's already been predetermined. And I have a defined loss that is acceptable to me at that stop level. That's a critical part of risk management. Okay, so I got a blue line that's my entry, I got a red line that's my stop, and this green line is my target. And my target on this short trade on Ingersoll Rand, so it's had this big, marvelous run up. This is wave 3. It's an impulsive move, and we have clearly begun a correction. And so I'm looking for price to get down into the Fibonacci retracement level between 38.2 and 61.8. And I notice that the 200-day moving average is kind of in the top third of this retracement zone, and that's a potential strong support level. So I'm going to set my target for this trade at the 200-day moving average in the Fibonacci retracement zone. So my target's 110.25. So if it hits 110.25, I'm not going to automatically exit, because if it breaks the 200, it could really free fall. So I want to be part of that. But what I use the target price for is to determine the reward to risk for the trade. I want the potential I will lose if I hit this stop. If it fails and I go from my entry to my stop, I want that to be smaller than the potential reward if I, from my entry to my target. So that's kind of the minimum. This has to be bigger. And this one's about 1.6 to 1. So that's a reasonable reward to risk for me. I like it bigger, but so I like this. And there's still time to get into Ingersoll Rand short. So I do all my analysis for a trade, my entry, my stop, my target. And then I prefer to trade that with an option, and I trade, I don't do spreads. I don't sell, credit spreads and all that stuff. I don't do butterflies. I don't do any winged creatures. I just take a simple, long position in the option. And so for me, in a downtrend, that is, and that's, by the way, if you use any kind of option calculator, and you set up the parameters, go, what's the lowest risk, highest reward for a high probability directional move that will always be a long option position, always, without that. So that's my lecture on that. So I like to go far out in time, so I have time, and I'm not, because I'm at the money or in the money, I'm not paying so much for time, right? So I got this one. This is the December 20, 115 put, and I'm long the December 20, 115 strike put on Ingersoll Rand, and it's already in profit. That's awesome. Okay, I'll show you this trade IVZ. It's too late to get in, but it's just makes me feel all warm to look at it again. So we got short on IVZ at 1875. We had a target at 1575. It's under the target, and it's continuing on down toward this ultimate wave 5 target. I had this set initial as a conservative target because that was a prior low. We broke it. That's awesome. Why did I get in this trade? Because there's a super clear Elliott Wave pattern here that once your eye is trained is like unmistakable. And here it is, wave 3. That's all I really care about. Impulsive move. There's 3, 4 into this zone, right? Clear evidence low, lower high, new low. Breaking the Ichimoku Cloud. That's where I went long, short. And we got a super nice winner here. So it's that simple. So that's what we're trying to do here. And I got to get my cursor back. And Jim says, pay attention to the patterns, not the ticker. There you go. It's all about patterns, right? So that's one, too late. Too late to get in. It's already at the target. There's another good one. Let me show you. Oh, I just triggered off my watch list. So I keep a watch list here of trades that I'm super interested in. I set alerts and triggers, and when they hit, I come back and look at them. So here's CERN triggered after hours. I wanted it to break this prior low. So we got big impulsive move up, and now we got low, lower high, low, lower high, right? It's below the cloud. The cloud is turned. I would have taken it here, but I just saw it now. Oh, I want to take out that low. I want to take out that low of 69.09, and it did after hours. So tomorrow, if it opens up under 69.09, I'm short. Right? My stop's going to be here, and my target's down here at the 200-day in the retracement zone. Look at this. I got a 2.5, 3-to-1 reward to risk ratio. So that is a good trade for me. So I'm liking it. All right, and question, the ticker's watermarked in the background, it's up in the box here. I try to call it, it's here too. So hey, I'd be happy to analyze any tickers, any charts you are interested in. Now remember, I said in my trading room, I look at 30 to 50 symbols in the trading room and find 3 to 4 good trades. So more than likely, I'm not going to like the symbols you bring up just based on probability, but I'll offer my analysis on it. And sure enough, Brad brings up TLT. I'm very familiar with TLT, and I can tell you already I don't like it. And that's not because it's not a good trading instrument. What I don't like is the fact that it's too late to jump in. What a beautiful run it's had. But the real trade on TLT was when the trend changed. If you look here, as it put in a high, higher low, new high, and broke the cloud, and you could have been conservative, let it break the 200, take an entry back here, it pulled back to the 200, found support, off to the races. And even as it came down through the cloud and broke out here, you could have taken an entry. But now this is very long in the tooth, and I think it's a mistake to chase a mature trend. So I think that one's gone, but it was beautiful for sure. Bill's asking about Goldman or XLF. Goldman's on my radar. We were looking in the trading room at several of the banks. Several of them are heading down, right, with the yield curve inversion. Right? Banks, it doesn't really matter what the interest rates are to banks, but that arbitrage between short and long term absolutely matters to them because that's where their profit is. Goldman looks good because here's a big impulsive move down. There's a perfect correction, and now it looks like it's heading down. It's under the cloud. It is under the 200. I could be shorting Goldman very, very soon, so that's cool. And XLF is the financial spider ETF, I believe. Yeah. It's similar to Goldman. We want to watch this really close. It's got this higher low. And we would definitely want to see a close below that. So we're below the cloud, we're below the 200, but now we got a prior support level. So I want to see a close. If it can do it, there might be something cooking there. Jake says Shopify. Let's have a look. Same thing as TLT, right? We just, once your eyes trained, you can see it in an instant, right? Beautiful trend. Who wouldn't want to get in here as it broke the cloud, broke the 200, would have been awesome. Take it from 150 up to 350. But the next trade on this is a correction, and it's not there yet. We got a low, but we need a low, lower high, new low. We need to break the cloud so we're not even close. Right? I don't chase mature trends like that, but what a beautiful trend it is. Easy, GLD. Yeah, let's look at the gold futures. GLD is going to follow the futures. The futures are a little more accurate. Okay, kind of similar, right? Actually got a 1, 2, 3. We're in an impulsive move here. Gold could go up just from a fundamental macroeconomics, flight to quality standpoint. But again, it's a very mature trend. It's I think the explosive part of it may have already happened. So I think we got to look for other trades. But there was a good entry. This is not, as it's broken away from all the averages. Even if it's going to continue up over the long term, there may be some kind of reversion back to the cloud or the averages. So I don't think it's a good entry point for gold. Tim wants to see Uber. I do not trade IPOs, but it's fun to look at them, right? So big move up, and now it's down below the IPO price. And I read articles about all these companies, and they're losing a lot of money. And there's quite a bit of commentary. We don't already see the path to profitability here. Okay, I'm glad they're available for now. This would be the impulsive move, and if you can find signs of a reversal down here, a high, higher low, new high, you could get a reversal. And if it reversed at this price, we don't know that. That's but if we reversed at this price and got some evidence of a high, higher low, new high, your retracement zone would be up here with a midpoint of 39.32. And Bernie says, got to be pretty confident with your strategy to enter out of the money. Most of the time I go in the money, pretty deep in the money with a high delta. There were some things with IR that made me go out of the money, but typically I'm going in the money with a directional long option. Dina, ENPH. Well, what am I going to say? What a beautiful trend. And a little late to chase. You got to wait for a correction to develop, and it's too early for that. Again, look how it broke the cloud, and when it pulled back into the cloud, I gave you a couple other entry points, but look how the separation between it and all of it, it's just too late to chase. There's not a good entry there, I don't think. Billy, MYOV. I don't recognize that one. Well, Myovant Sciences. Got a big gap here. Obviously, they're not having a good summer. Down to $7 from 25. Starting to find a little bottom, so there may be a retracement up. So this is the current impulsive move here. You'd want to watch the gap. Gaps can provide support or resistance. In this case, it would be resistance. So you got a little high, higher low. If you bust out, maybe get above the cloud here. It's going to be $8 or $9. You can take it up to 14. That's not bad, but you got to see some proof of that. It's not there yet. Okay, one more Baidu, and then I'm going to have to wrap up. I know it's late in different geographies and all that. So Baidu. Man, it's down, 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 down. No signs of a bottom yet. The next trade would be up, but it has not proven it. Everything's red. So if this is the bottom, that's a big if, right? You see a high, higher low, new high, then there's a target at about 180, but it is not anywhere close to being ready for a long net. All right. Well, let me start winding things up here. We looked at several charts. I gave you two of my ideas, right, for trading, and I offered my feedback on news, right? So, hey, here's a special offer. If you liked what you saw today, if you thought my analysis had some meaning, if you'd like to participate in the trades I take, I'll make a quick offer for you. Join my service. I run a stock advisory, a pick service, and it has a live trading room with it. You can try that out for $37 for 30 days. And I don't know if Becky's going to post a link or if I'm supposed to post a link. Let me know. You can see it on the screen here. You can type it as well. But there's a link coming here shortly. Is that in the announcements? I will post it. And here's how this works. If you're interested, well, that didn't work. There it is. Okay. And Paulette says, are you trading mostly options? What I do is everything starts with a chart, right? If you look at my setup here, my setup for Ingersoll Rand is a good example. So IR. I set the trade up on the chart. I go, hey, good entry, 117.04. The stop. We'll close the trade at 120, 128. We got a target of 110.25. So those who like to trade shares can just go short the shares. Those who like to trade options, I've provided an option contract recommendation, the one I'm trading it with. So you can do these. So every trade, 99% of my trades, they all have an option, right, component to them. You can trade them with shares. You can trade them with options. It is your choice. And some people do both. Right? Your money, your choice. Okay, so 30 days, $37, trial, 100% money back guarantee. So hey, you come try it out. You sit in the trading room. You see some of the trades. You're going to get 4 weeks. We do 2 to 3 trades a week, so you're going to get 8 to 15 trades. If it's a good fit, awesome. Stay with me. It renews at $97 a month. If it's not your thing, 100% money back guarantee. No questions asked. No hard feelings. Right? No playing games. If you're going to stay, we want you to be all in and feel good about it. And I got a bonus. I talked about here's everything you get. Here's what you get with the service, right? The watch list. I showed you I got a watch list that I'm waiting on. So you get a list of the potential trades. You get an alert, email, text message. Now I've added Telegram messaging app for people all over the world. So when I'm getting a new trade, you get an alert. You don't have to come to the trading room, right? You can just get an alert. You get the exact details of the trade, the entry, the stop, the target. Most trades, 99% can be traded with shares or options. Your choice. I provide an option contract. You get alerts, email, text message when I make a change. When I move a stop, take profit, close the trade. So you're with me every step of the way. And by the way, every trade that I publish, I'm in it with my money. I'm taking the trade too, and my brokerage accounts are audited quarterly by a CPA. They take my statements, they look at what's on the website, and they say, did he actually do what he said he's doing? And of course, I wouldn't go through that if I wasn't. So I take every single trade, and the results that I publish are results that I'm getting in my own account. Okay, you get access to a live trading room. It's Monday through Thursday, an hour at the market open. You can attend if you like. A lot of people like it. Come in and ask questions, follow along, see how the sausage gets made. It's not required, and there's a recording and a recap. You don't have to come. You can just get the alerts when we take a trade. We have a weekly live chat session if you can't make the morning, but you still want to participate. Wednesdays, 6 p.m. Pacific, 9 Eastern. And when you sign up, you get a link to my calendar, and we can have a one-on-one consultation, answer your questions, get you off to a great start in using the service. I provide tools for risk management and some option trading training. So, my approach to risk management, I give you some tools, some calculators. My approach to options, I give you some information, how many contracts to buy, how to manage the trade, some live market recordings of that, and some study guides, and ongoing support and training. And there's more. One more thing. So I talked about my Ichimoku Cloud approach. I had so many questions about it. What I do is proprietary and unique. I have different settings, different approach to using it. So a bunch of people ask, hey, how do you do that? And so I wrote a course. List price on my website for the course, $247. It includes proprietary cloud settings, and I got a unique version of Ichimoku Cloud available for Thinkorswim, because theirs won't do my settings, but I got a study you can import if you like Thinkorswim. It works, and you can do my settings on TradeStation or other platforms. You got a written study guide. You got training videos, printable trade setup cheat sheet. Right? List price $247. If you sign up for the trial, special offer for Candlestick Forum folks. You sign up for the trial, 30 days, $37, and I'll throw in that course for free. Okay? That's only from now through the end of the weekend. So folks watching the video, you can see the URL on the screen, probably in the email you got. Right now through the weekend, if you sign up for the 37-day trial, you're going to get the picks, and you'll get the bonus of the Ichimoku Cloud course, $247 value included for $37. And it all has a money-back guarantee, 100%, no questions asked, no hard feelings. It wasn't a good fit, get your money back. Most people stay. Most people like it. Okay. And Barry saying, can I share my 2008-2009 trading record? You can see my trading record going back as far as you like. Let me find my browser. Somewhere I have a browser. And do is you go to followmetrades.com, my homepage, scroll down midway. Here's a table starting at 2013 through today. Click on any of these green buttons and you'll see every single trade I've taken in any given year. in complete detail. Every single trade, whether it won, whether it lost, how much it won, how much it lost, how long I was in it, whether I traded it with an option or with stock. Complete transparency. I think that's critical. And like I said, I have those results. What I paste here on these trade details is audited by a CPA, third-party firm, and they come produce reports and say whether I actually did what I said what I did. So, website is there it is, followmetrades.com. It's posted the link in the chat box. And Jim's saying sometime tomorrow you get a recording of the presentation. Hey, thanks, Barry. All right, well, hey, I sure appreciate everybody showing up. I had fun presenting this material. I appreciated your questions. It was fun looking at your symbols that you were interested in. So I'm going to wrap it up. If you got the last few questions, type them in there. But I'm done with the material that I really wanted to present to you. And again, I thank you for your time and for your engagement. It was really good. And there will be a email coming out with a link to the recording and a link to that offer. It's good through this weekend. You get that bonus. And if you're interested, that's a really good deal. Hey, John, thank you. Thank you and everybody else. Brad, yeah, you're welcome. And yeah, check it out tomorrow. Paulette, hey, Kirk, Lynn, everybody. Billy, you guys are awesome. All right, Mr. Steven, I think it's back to you. I think I'm done.
Thank you very much. Very good stuff. Everybody, take a look at Dean's information. I mean, he's been very successful with it, and this just adds more high probability setups for your trading arsenal. So you're going to get well more than your money's worth with Dean's background and the information he provides. So, Dean, thank you very much. That was good stuff. And everybody,
all right, thank you. I always enjoy it. Look forward to coming back someday in the future.
All right, good. Everybody, thank you, and have a good evening. We will see you bright and early in the chat rooms. And once again, Dean's information is very high-quality information. So you'll get more than your money's worth, as I always say, using his information to kind of put into your mental trading arsenal. So with that, everybody have a good evening. We'll see you in the chat rooms.